Welcome to our CFP Exam Prep podcast. Today we're diving into Section 1244, Stock, a crucial concept that frequently appears on the CFP exam and often trips up candidates due to its specific requirements and limitations. Let's break down Section 1244, Stock. This provision allows investors to treat losses from qualified small business stock as ordinary losses rather than capital losses. The maximum ordinary loss deduction is $50,000 for single filers and $100,000 for married filing jointly. This is particularly valuable because ordinary losses can offset ordinary income, which is typically taxed at higher rates than capital gains. Now, here's where candidates often make mistakes. Not all small business stock qualifies for Section 1244 treatment. The stock must meet specific requirements. The corporation must be a domestic company. The total capital received by the corporation for stock issuance cannot exceed $1 million. The stock must be issued for money or property, not for services. These requirements are frequently tested on the exam. Let me give you a practical example. Imagine Sarah invests $75,000 in a qualifying Section 1244 stock. The business fails and her stock becomes worthless. Without Section 1244, her loss would be treated as a capital loss, limited to offsetting capital gains plus $3,000 of ordinary income per year. However, under Section 1244, she can deduct the entire $50,000 as an ordinary loss in the current year, with the remaining $25,000 treated as a capital loss. Here's another common exam trap. The original investor must be the one who sustains the loss. If the stock is gifted or transferred, Section 1244 treatment is lost. For example, if John buys qualifying stock and later gifts it to his daughter Mary, any subsequent losses Mary experiences won't qualify for Section 1244 treatment. The timing of the loss recognition is also crucial. The loss must occur when the stock becomes worthless or when it's sold at a loss. The corporation must have derived more than 50% of its gross receipts from sources other than passive investment income during the 5 years preceding the loss. Let's address a frequent exam scenario. The question might present a situation where a taxpayer has multiple Section 1244 stock losses in different companies. Remember, the $50,000 or $100,000 limit applies to the aggregate of all Section 1244 losses for the tax year. If a married couple has losses in 3 different qualifying companies, totaling $150,000, they can only treat $100,000 as ordinary loss. When preparing for the exam, focus on these key aspects. First, understand the dollar limitations. Second, know the qualification requirements for both the corporation and the stock. Third, remember the original investor requirement. And finally, be clear about the passive income limitation. A practical tip for remembering Section 1244 is to think first loss, better deal. It's first because it must be the original investor, and it's a better deal because ordinary losses are more valuable than capital losses for tax purposes. Section 1244 represents an important tax benefit for small business investors, and understanding its nuances is crucial for success on the CFP exam. Remember these details, and you'll be well prepared to handle any questions related to this topic on test day.